What's up, YouTube? Eric here. I want to bring you a stock market update, discuss some stocks that I've been buying here recently, and just some overall thoughts. Lots of news here to cover. This is a big month for the stock market. You can see all the major indexes are doing very well today. The Nasdaq's almost up 1%, S&P's up 0.84%, Dow Jones up 0.62%. That VIX has dropped 6%, now sitting at 16.62. Now, part of the reason for the recent volatility had to do with the Treasury yield spiking, and we've seen mortgage rates now in the 30-year mortgage over 8%, starting to get pretty high compared to what we're used to, at least in the last decade or so. If you look at the 10-year Treasury today, 4.657%. So it's down slightly. It's come off those highs. Now with oil, we've had some volatility. With oil, we had a spike here on Monday because of the war situation. If you look at oil right now, sitting at about $85, down about 1.19%. So huge week when you think of the macro. Tomorrow, Wednesday, October 11th, we're going to have core PPI. We're going to get the PPI, the Producer Price Index results. Then on Thursday, October 12th, we're going to have initial jobless claims in the morning, also core CPI. So we're going to hear about the Consumer Price Index, inflation. We're going to hear from the Fed, see what's going on there. And of course, this commentary, these results could move markets either direction. If you're watching this channel, you already know this because you're an intelligent investor. You know what's going on. But of course, if you have inflation spike, you're going to have the market gyrate, probably sell off. Higher inflation means the Fed's going to raise rates again here next month. It's going to cause another chain reaction. Now, right now, it's clear that the market wants to go higher. We've been talking about the technicals on the QQQ, the NASDAQ 100 around 352, 354. It's really tested that area a couple of times, and it's rallied off of that area. I said this morning or yesterday when I did the live stream, Patreon Discord, the market really wants to go higher. It doesn't have a whole lot of catalysts, so it's being extremely resilient. I think you're seeing the market want to close the end of the year higher. You look at the Santa Claus rally, the year-end rally. We had a pretty rough September, early October. You're seeing the market start to get some activity, some buying. So today, Tuesday, October 10th, we had Pepsi report this morning. Earnings were decent there. You can see this month is going to get exciting very quickly. You can see later this week, we're going to have Delta Airlines, Domino's Pizza. Then the banks are going to start reporting. You're going to have BlackRock, Citi, Wells Fargo. And then just next week, the 18th of October, you start to see Tesla, ASML, Lam Research, Netflix, Taiwan Semiconductor here on the 19th. And I'm just going through this really quick, kind of a live session here. You can see on your screen though, Meta 25th. You got SoFi here on the 30th. You start to see some big names like Apple here. This is going to be on the 2nd of November. So earnings season has officially kicked off, and it's going to get exciting quickly here, especially as you get towards the end of October into early November when those mega cap tech companies start reporting earnings. So earlier I mentioned Pepsi. Earnings per share, they beat by about 10 cents, and then revenue was a slight beat, 23.45 billion versus 23.39 billion expected. Before market opened this morning, Paul Tudor Jones says it's hard to like stocks given geopolitical risks, weak U.S. fiscal position. Let's talk about this for 1 second. I try to drive this home all the time. If you watch the masterclass videos, if you're watching YouTube, I always talk about basically the spectrum. You've got two different parts of that spectrum if you're an investor. You're in the accumulation phase, so you're younger or you're just starting out investing. You don't have a lot of capital. You don't have a lot of wealth. You're trying to grow that wealth over a period of time. Then on the other side, you've got preservation. So if you're a billionaire, it's going to be a lot different situation because you've already made your money. You only have to get rich once. So you have these billionaire hedge fund managers that come on TV and they try to scare you out of the market saying it's not a good time to invest. Well, in the short term, there's certainly a lot of macro risks that we've been talking about on this channel week over week after week. If you're thinking longer term, you zoom out the lens, there's never really a bad time to buy if you're trying to accumulate wealth. Now, on the flip side of that, if you're a billionaire, there's almost never a great time to invest in equities. You're looking at things like bonds. You're looking at safe havens like gold. He mentioned other things like crypto. There's nothing wrong with those strategies at all. But let's just focus for a second on something like bonds or gold. Yeah, sure, you could go get a treasury, get a 5% return. And that's great if you already have your money. You've got multi-millions or billions of dollars. If you're trying to grow wealth and you're trying to get to that promised land, you're not going to get there off of 5% annual returns. It's just as simple as that. And so this is very polarizing. It's oil and water because you've got one side that's always very cautious about, taking on too much risk. And then you've got this other side that's maybe takes on too much risk. They go all in on spec stocks, YOLO, so on. Where's the middle ground? I think Fired Up Wealth tries to give you that middle ground. We're trying to think about 5 years, 10 years and beyond as an investor to grow and accumulate wealth over a period of time. So preservation is not necessarily the focus. It's more about accumulation. Now, I know I'm going to get some comments after I say that, so I'll try to nip it in the bud right now. It doesn't mean that you shouldn't have any risk management. You have to invest based on your risk tolerance, your suitability, your goals, your time horizon. So I'm not saying just YOLO into anything. I'm saying if you're investing in quality companies over a period of time and you're not thinking about 6 months, but you're thinking about 6 years, that mindset's going to serve you well if you're trying to accumulate wealth. That's the message I'm trying to get across here. The overall market, when you think of the length of time that investments, when you think of stocks, how long they're invested, the amount of time that stocks are held has come down significantly over the last couple of decades. The average now, I believe the last time I saw was under 6 months is the average time a stock is held. So most people at best are probably swing traders. The majority are more day traders, and trying to be a long-term investor, you're really a unique thing. That's why we call it investing aliens. You're a unique breed. You're kind of going against the grain, and it's very hard to be successful when everybody is against you and you're getting so much noise, so much different information telling you that investing's bad, that you can't make money. You have to remember, everyone has an agenda, and most of those funds, especially hedge funds and billionaires, they have a completely different goal and perspective. Capital preservation is the primary focus, and it's a very different thing. The sooner you understand that and the psychology behind it, the faster you can be successful as a long-term investor and not get scared out of the market with FOMO, fear of missing out, and full fear of losing everything. And what that means in simple terms is when the market's going higher every day, you just want to buy because you're afraid you're going to miss out. The market's going higher and higher. When the market's going down, you're afraid of full fear of losing everything, that the market's just going to go to zero, that the stock's going to go lower. So you're afraid to ever buy because you're like, what if it goes a little bit lower? And this is why dollar cost averaging works for growth investors. It simply does. It's a proven fact. The data is there to support it. Now, with all that said, it's important to understand the macro. There are plenty of macro risks. You think of macroeconomics, geopolitics. It's a very sensitive period right now, so I'm not trying to discount that. This headline here, consumers starting to buckle for the first time in a decade. This is from a former Walmart US CEO, Bill Simon, a warning here on CNBC. This talks about price points. You're not real proud of your price point. They usually say a 50-inch TV is $199 or something like that. And now they say a 50-inch TV is 40% off. You use percentages when you're not real proud of your price point. I think you've got inflation pushing the relative price points up. And he's blaming the headwinds on things that we talk about all the time, including inflation, higher interest rates, federal budget, polarized politics, and student loan repayments. We talk about how the US GDP, 68% is consumer spending. Well, if interest rates are higher, that means mortgage payments are higher. That means rent payments are higher. You have inflation pushing up food prices, gas prices, and so on. The consumer is squeezed. There's less disposable income to spend on other stuff. And that could, of course, impact the economy and overall GDP. And that's why a lot of people are in that recession camp. Now, if you want my 2 cents, I'm not in the recession camp, but at the same time, I know that nothing is impossible. So I don't try to be stubborn and sit here and tell you there's no way that's going to happen. It could certainly happen. The way I look at that, I try to take a silver lining in everything. I don't need my money right now. I've got time. I'm looking 2030 or beyond. And so if there is a recession, it's going to give me an opportunity to buy more stocks at lower prices, accumulate shares. And on the flip side of that, when you do get that multi-year bull run, that's how you accumulate wealth. You get rich in bear markets, not in bull markets. Bull markets is where you take the profits off of what you bought at lower prices in the bear market. Now, some positivity here, and this is very polarizing. You can see both sides of the story. IMF raising growth outlook for US on stronger than expected momentum. So the IMF, if you're not familiar, is the International Monetary Fund. On Tuesday, raised its 2023 growth outlook for the US on stronger than expected momentum in the economy. Growth forecasted in the US in 2023 was raised by 0.3 percentage point to 2.1%. Now, that's not stellar growth, but that's not a recession. You need to have retraction, restriction. You need to have negative growth for a couple quarters to get that recession. While the 2024 outlook was raised by 0.5 to 1.5%. So it's showing that the economy is going to slow down, but it's not necessarily saying we're going into recession. This reflects stronger business investment in Q2 and resilient consumption growth. Now, the question is, will that consumption growth stay strong? Will that demand stay strong because you have lagging data with all this information? And as those student loan payments kick in, people have less money to spend because things are more expensive. What does that look like in 1 or 2 quarters? However, with wage growth slowing, savings accumulated during the pandemic are running out. So during the pandemic, we got stimulus, we saved money, we didn't spend as much money. We're starting to run out of those savings. And overall, we still do have a strong labor market. Unemployment is still very low. I think the last time I looked, 3.8%. Another quick headline, this could be important for Tesla. Treasury Department to make it easier to get $7,500 EV tax credit in 2024, so next year. So the proposed rules issued Friday would let car dealers offer the EV tax break to consumers at the point of sale. This is big, regardless of their federal tax liability starting January 1st, 2024. This could be a catalyst for stocks like Tesla. Update here on Unity, and this is massive news here. So the CEO is out at Unity effective immediately. And it says the board will initiate a comprehensive search process with the assistance of a leading executive search firm trying to find a new CEO. In the meantime, James Whitehurst, now he came from Red Hat, and Red Hat was acquired by IBM. Red Hat was a pretty good company, I think, before it got acquired by IBM. So James Whitehurst will step in as the CEO temporarily, and they're looking for this new CEO. You're probably aware of the news here. There were actually death threats at the corporate office. Some threatened to never use Unity again or switch to a new platform in the middle of developing their next game. And this impacted some companies in a big way. You're in the middle of developing a game, you're almost at the end, you're ready to release a game, and all of a sudden the entire thing changes how Unity is going to do business with you. And that's because of the fees Unity planned to charge every time their games were installed, regardless of whether those installs were legitimate new purchases or whether their games were developed under a different previous agreement with Unity. And this opens a Pandora's box that we've talked about in Discord as well on the Platinum call here recently. In a nutshell here, this news is positive. Of course, you can look at this as trying to save face. Like they need a scapegoat. Hey, the CEO ultimately is responsible, right? He's responsible for the decisions that the business is making. So it does make sense. But also just if I'm a board member and I'm looking like, okay, the sentiment's so bad, people are hating us. Let's throw John under the bus and move on to the next chapter. I think it's a positive overall for the business. I think the intent here was to try to make Unity a profitable business. And I think they were trying to do positive things towards profitability, but they didn't do a great job of executing that plan. And they really rushed that plan. I think a lot of that was just because, Unity went public. Unity was making promises to investors saying they're going to be profitable by X date, X, Y, Z. And by trying to make those promises come to fruition, they were doing things in a rush manner. And of course, that's never good for business. And it upset a lot of people. I think this will help that kind of tension go away over time. You've got a scapegoat. You've kind of got somebody that you can throw out and say, okay, sorry, our bad. We're moving on to the next chapter. So positive for Unity. We're going to have earnings season here coming up. It's going to be important to see what this business is doing. I do like this company longer term. It's very speculative. Of course, it's not profitable and it has a long ways to go. When the stock's under $30, if you're thinking for, 5-year investment, 5 or 10 years, I think it was attractive. Even nibbled some shares, I think, in the Fired Up Wealth community portfolio. Several different members from Discord were buying this stock as well. Some other big news this morning, AMD to acquire AI software startup in effort to catch NVIDIA. Now, we've talked about NVIDIA on the channel. NVIDIA's got that full stack, the AI stack that includes both hardware and software. And AMD's been making some strides in this area. This acquisition is going to help with that. So we talk about how NVIDIA has that ecosystem. AMD is going to be that second competitor, but they are behind. They're years behind when you think of that full stack, product and that process they have. So AMD has vowed to invest and build a unified collection of software to power the various chips the companies makes. Quote here, this is from Victor Pang, AMD president, we're executing to that strategy and doing it through internal investment as well as external acquisitions. The acquisition of Nod.ai fits into the strategy because its technology enables companies to deploy AI models that are tuned specifically, of course, for AMD chips more easily. Nod.ai sells its technology to large data center operators, among other customers. Now, if you're looking for stocks to buy, it's really going to be specific to you, your blueprint, of course. Now, if you missed out on the big 7, the magnificent 7 or 8 stocks, the mega cap tech stocks, the Amazon, the Google, NVIDIA, you get the idea, Microsoft. If you missed the big run that we had this year on those companies, I think you have to look at something like the Russell 2000, some smaller cap type stocks. Now, I've been buying a few of those. ACMR is one of the stocks. ACM Research. Also Navitas Semiconductor. Now, if you want to know more about both those stocks, go watch the last video. I did a top 7 stocks to buy for the month of October, and it goes a little bit deeper into both of those names. Another one that I've owned for a while, bought this in 2021, up about 500-600%. Actually, House shares at this point has taken profits. Axcelis Technologies, this is ACLS, specializes in designing, manufacturing, and servicing ion implantation. This is going to be semiconductor equipment. And the reason I got into it really because of when you think of EV, you think electric vehicles, this is a big push, a big part of their business. And this is saying that 34 hedge funds were bullish on Axcelis compared to 24 funds the prior quarter. Of course, this has come down significantly. It was over $200, came back into the 160 level, something to explore. Another one that I personally don't own this, but I know a lot of people are bullish. It's very in fashion, especially when you think of hedge funds, you think of Wall Street. Super Microcomputer SMCI. And a lot of people have asked me about this stock. For me personally, it's just not that exciting. A lot of people like to put this into semiconductor equipment, but it's not really that. If you understand the business, it develops and manufactures high-performance server and storage solutions based on modular and open architecture. So the product range includes storage systems, modular blade servers, workstation, networking devices, and so on. The reason this is a big play, if you're building these data centers, you're building these supercomputers, you're going to need chips, GPUs and CPUs, but you're also going to need this type of hardware to build those data centers. And that's exactly what SMCI offers as a business. And so for me, if I look at the margin profile, if I look at the overall business, it doesn't really fit in my portfolio, but I do think the stock's going to go higher. If you look at it's in fashion, 36 hedge fund portfolios compared to 34 in the earlier quarter. So 36 hedge funds are bullish on this. You have to remember with hedge funds, they're generally not holding for multiple years. They're trying to ride waves. So it's more like swing trading often. And there's nothing wrong with swing trading, but you have to understand that generally that's the intent there. So I think this one is one you could ride as like a swing trade or something like that. It doesn't fit into my personal blueprint as a long-term investment, at least not yet. I have to do more research on the company. I've probably only spent maybe 20 or 30 hours looking at this company, and I generally need a lot more time than that. So another stock here I've been buying, and if you're new here, guys, make sure you subscribe to the channel, click that bell for notifications, and if this video is helpful, drop me a like and a comment. But Square Block, this is one that I personally thought was a good buy when it got beat down here recently. You can see on a quick chart here, it didn't quite break $40, and I did buy some when it was under 45, and I had another limit order to buy, and it missed by 20 or 30 cents. You can see it's bounced nicely off of that $40 level, trading right now over $46 a share. So Goldman Sachs maintained the buy rating on Block on Tuesday, calling the recent pullback unjustified. Since the start of 2023, it's down about 32.4%, at least when this was written. And if you look at it, it's trading at basically the lowest it's ever traded since it went public. This is saying 2.9 times 2024 enterprise value to EBITDA estimate. According to Y charts here, it's trading at like 1.336. I think it's closer to 1.45 or something right now, but it's under 2 price to sales. And of course, that doesn't mean it's automatically a buy, but it has been getting pretty attractive, and that is one that I've been nibbling, and I was hoping it was going to go under 40. It didn't quite get there. So earlier we talked about the NASDAQ 100, the QQQ, and we do chart day every single Wednesday in Patreon Discord at 9 o'clock a.m. Eastern. So we're going to be doing one here tomorrow morning. We always cover QQQ and 20 individual stocks that are chosen by community members. So if you look at QQQ, I mentioned earlier how it bounced off of that kind of 354 level. It really was 352 this time. So previously it was 354. This was back in August, the middle of August. We got the 354.71, and it actually ripped up here to $380, and then it pulled back. It slightly broke that. So you can look at this, and I mean, it's basically a double bottom at this point. There's no guarantee. Of course, if the macro is always going to be more important than technicals. So if the CPI data comes in hot, inflation comes in hot, well, this could sell off and come back where these yellow circles are. But looking at this, it's not exactly 354. It slightly broke that, but it's essentially a slanted double bottom, and you could see this rip back up to these levels by the year end. And for perspective, the current R3, so Fibonacci pivot points, is about $393. The previous R3 was at $400, and I do think you'll get heavy resistance at $400 if it gets there. You probably recall me talking about this before on the channel if you're a regular visitor to the channel and you watch most videos, but we kind of topped out at $404, $403.99, November 19th, 2021. So basically 2 years years ago, we have not gotten back to that level. The 52-week high on the QQQ right now, $387.98. So in order for us to really have a bull run that continues beyond, we have to take out that previous high at $404. And of course, the macro is going to be most important. You think of inflation, you think of CPI data, interest rates, and what the Fed decides to do there. I think most people would agree that the Fed might raise rates one more time in November. That's going to push interest rates and treasury yields higher one more time. You could see another blip of volatility, but the market's trying to look forward. Of course, next year we have an election year. And at some point here, I do think we're going to get to the other side of this. We're going through a bottoming process. We had a V-shaped recovery when you look at the pandemic, but there was a catalyst for that. That was stimulus. It's something that we've never seen before. It's unprecedented. I know you love that word, Stuart. Unprecedented. When you look back at 2020, when we had the stimulus, V bottom recovery, we went to a bear market with a V bottom recovery. Now that's not the situation we're going through here. We basically had a rolling downward market going into bear market 2022. We tried to get out of that early 2023. We really did get out of that, but we've had a correction from those recent highs. Essentially on the QQQ, we sold off around 10% from the top of the highest point we've seen here this year. And so that's a correction. It's healthy. The market's trying to get past that. And if you look at the QQQ, it's actually up 40% year to date. And over the past year, it's up 39.15%. So even though you might have a bunch of spec stocks that are beating up your portfolio, you might be thinking, this stock market thing's not for me. You have to understand that the quality names, people have been buying those. And the reason they're buying those is that they have strong balance sheets. Of course, AI has been a big part of that as well. At some point, those more speculative stocks, those smaller cap, we mentioned earlier, Russell 2000, those are going to start to rip. And you're going to see a lot of the names that haven't gone up, like those 7 or 8 big cap tech names, you're going to start to see other names participate when we get in that true multi-year bull market rally. And there's no guarantee exactly when that starts. Maybe it starts now. Maybe we have a run up and, like I said earlier, some more volatility before we really get to the end of this. I'm confident if you're investing in high quality names, you're going to be happy, but you have to have appropriate time horizons and make sure you're investing in quality companies. Hope this video is helpful, guys. Make sure you check out our Patreon. Go to patreon.com/firedupwealth. Join our Discord. It's the best investing community on the planet. If you're new here, subscribe to the channel. Click that bell for notifications. Drop me a like. Drop me a comment. Have a great rest of your day. Take care.